The idea of a retirement plan, whether it's employer sponsored or individual, is you're saving money, putting it away for retirement, and then later on, when you're old enough and or no longer working, you're going to take that money out to fund your retirement. Now, if you're using it in some other way, then you're going to have some tax penalties. So the idea of traditional IRA is the reason that Congress lets me not pay taxes on it now is because they want me to save for my own retirement so that I don't have to go on welfare in my 60s, 70s, or whatever, or I'm not a drain on the economy. I'll have some money saved up for myself. So that's the incentive. You have an incentive to save up for retirement. And anytime there's an incentive, there's going to be a drawback or a stick to go with the carrot. So let's say I put money away for retirement and I get this nice $6,000, $7,000 deduction every year. And then I say, well, screw it. I'm just going to take that money out and go blow it on blackjack.
You're all in there.
Yep. Well, here's our penalties. The three main penalties are there's a 6% penalty for putting too much into retirement because they have a $6,500 limit. So if you put more than that, there's a 6% penalty for excess contributions is what that's called. A 10% penalty for premature distributions. So when I go on my Las Vegas vacation with money that I should have been saving for retirement, then I'm going to pay an extra 10% penalty. And only 25% of the money that you should have taken out but didn't. Or it's reduced to 10% if you corrected it as soon as possible. It used to be, I think 2023 was the first year it was different. It used to be a 50% tax on, so my required minimum distribution, I'm supposed to take $15,000 out of my IRA. And I go, oops, I'm old and senile. I forgot to take any money out of my IRA. I would have a $7,500 tax, which I would probably pay by taking it out of my IRA. I pay tax on it again. That's a huge amount of tax, 50%. And basically, if you ask the IRS to waive that penalty, they wouldn't. The IRS just didn't like to apply that huge penalty. So I think Congress said, well, if we reduce the penalty, then maybe the penalty is more likely to be actually applied instead of waived. So it used to be a 50% penalty, but all you have to go is say, oops, I'm old and dumb. Please forgive me. And they'll say, okay, don't worry about it. But now 25% penalty is low enough that we actually see it stick. This is something that happens quite a bit, frustratingly large amount of time, is let's suppose someone, young professional or maybe a tradesman or laborer, they're used to making, let's say, $120,000 a year. And they're putting money away in the 401k. And they're putting close to, let's say over the last 10 years, they put away $200,000 into their 401k. And so they're in their 30s, they're not even thinking about retirement. They change jobs and they say, $200,000 in my 401k, sweet, just send that to me. I don't need to save. I'm only 32. It's too early to think about retirement. And maybe they use that for a down payment on their house, or maybe they could just pay off their mortgage or whatever. Well, if they make $120,000 at their job, then after the standard deduction, they're probably in the top end of the 12% or the low end of the 22% tax bracket, assuming they're married. But then now they have on top of that the $250,000 out of their IRA, out of their 401k. So suddenly they just, for tax purposes, they just made $400,000 last year. That's their income. And suddenly they're in 32% tax bracket. And on top of that 32%, they're going to owe this 10% additional tax penalty.
Oh.
So now their effective tax rate on, not the whole thing, but their effective tax rate on most of their 401k distribution is 42%. But they're thinking, it's no big deal. They already took the taxes out. That's the way most people think, is like when they withhold 20%, that's the taxes. Well, that's not the taxes. That's an estimate of what your tax would be. And in this case, the estimate was way off. So if you took $250,000 out of your 401k, well, 20%, 50,000 went to the IRS, and you got a check for 200,000, which you can do whatever you want with. But then your actual tax on that 250,000 might be close to 90,000. 50,000 was already sent to the IRS, but now when you're doing your taxes, you got to find the other 40,000. And if you've already spent that money, it's gone. And even if you didn't spend that money, and you still have the 40,000 lying around, that 250,000 just became, now it's only 150,000. And your retirement just got a lot smaller. So, yeah. So when I see people in their 20s and 30s with a 1099, my heart skips a beat, because I know almost certainly they're gonna owe some taxes.
Yeah.
I had that last year. A young couple that got married and switched jobs and pulled his retirement, and they paid $15,000 in taxes. It was that. He was like, well, yeah, all this pool, he didn't pay any taxes on it. Yeah, she was happy. She was like, he's gonna pull out his retirement now.
When you take money out of your retirement accounts early, like before age 59 and a half, your 1099-R, that's this guy, will usually have a distribution code 1 right here in box 7. Distribution code 1 means early distribution without any known exception, and report the excess tax, the 10% tax penalty on Schedule 2. Schedule 2 is for additional taxes. And one of the additional taxes is here, additional tax on IRAs and other tax favored accounts. Line 8. So if you're going to just report the 10% penalty, and then you can check this box. You don't have to file 5329. So that extra $500 that I got, that's an early distribution. I'll just report the extra $50 in tax right here on line 8. Let's see. But if you take money out of your retirement early, there are some exceptions we can apply. We as your tax preparer, or you as the taxpayer, can apply directly on the tax return. So even though you haven't notified your brokerage or retirement plan sponsor of an exception to the 10% penalty, you can get out of it by using Form 5329. So this is part 1 is our additional tax on early distributions. This is the amount you would have to claim as early distributions. It's usually the taxable amount from your 1099. And then you can claim an exception here on this line. So this exception code numbers used to be from 1 to 12, but I think it's gone up beyond that. And then say, okay, the full amount or some portion of that is not subject to the additional tax. So they've gone from 12 to 21. But the main exceptions are, number 1 is if you left your employer after age 55, on or after age 55, and they start paying you a pension, even though technically it's early under the tax law because it's 59 and a half, not 55, that's still an exception to the 10% penalty. Number 2 is early retirement. You can annuitize is what's called, or you can set it up so that your IRA is paying you equal monthly installments for the rest of your life. And if you do that, you can avoid the 10% penalty. If you start a plan like that, you can't stop it until I think you have to be 65 or older before you can change your mind about that. Otherwise, you'll retroactively owe that 10% penalty. Permanent and total disability would be exception number 3. Distributions due to death is exception number 4. If you have unreimbursed medical expenses over 7.5% of your adjusted gross income, then that's an exception. We still have to reduce that by 7.5% of our adjusted gross income, but still, by applying this penalty, we save approximately $6,000 in taxes. This is an important one. Qualified domestic plan distributions made to an alternate payee under a qualified domestic relations order. What that means is if you're divorcing and part of your agreement is to split up the retirement for maybe the working spouse, maybe you have a working spouse and stay-at-home spouse. If your agreement is to split up the retirement, it's a mistake for the working spouse to actually take that money out of retirement as if it were normal distribution and just pay it over to their spouse. The correct way to do it to avoid the 10% penalty is to have the judge sign an order to the plan sponsor or custodian saying, please pay half of the balance of the retirement fund to the soon-to-be ex-spouse. And that has 2 advantages. First, it avoids the 10% penalty, and second, the tax burden will fall on the person who's actually getting money instead of. So we've had many people, at least 3 people I can think of, who've gotten divorced, split up their retirement. They took out a $300,000 check from the retirement company and signed it over to their spouse. And then by not going through this qualified domestic relations order or quadro, the person who's not getting the money, wasn't supposed to get the money, they're getting taxed on $300,000 plus the 10% penalty. If you use your IRA distributions, some of these are IRA only and some of these are retirement plan only. So if you use your IRA to, in certain cases, to pay for your health insurance, that's okay. That's an exception to the 10% penalty. If you use your IRA to pay for college expenses, and that can be for yourself, your spouse, your children, and any of your descendants, I believe, then it's an exception to the 10% penalty. You can use up to $10,000 of your IRA to purchase a first home. If the IRS garnishes your retirement account, then even though you'll still owe income tax on that distribution, they'll let you off without the 10% penalty. If you're called up to the reserves, sometimes the reserves pay much less than your regular job, and if you have to withdraw from your IRA to maintain your family standard of living that you're used to, then that's an exception to the penalty. Those are the main ones. 12 and up are all new, so I'm not quite sure what they are. And they're probably pretty rare.
20 is terminal illness.
Yeah, 20 is distribution due to terminal illness. And what's another one? Oh, qualified birth or adoption distributions. That one's new and might be useful for some of our of our customers. So if you take money out of your IRA to pay for your hospital bill while you had a kid, that's going to be an exception to the 10% penalty.